Hey there, Blockhead Traders. Here, Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Tuesday, November 21st, 2023, and this is Blockhead Traders Weekly. In this week's episode, it is a shortened trading week with the American-US Thanksgiving holiday this week, so I'm recording a little bit early, which means Viper will not be joining us. And in this week's episode, I want to touch on what happens after you get assigned. What do you do as part of your play? Because I've got two of these holdings that I have been assigned on that I am looking to make a play and sell some premium against in the upcoming trading week. So I'm going to talk you through it, what my strategy is, what my plan is, and kind of talk through some of the mechanics. But before we hop to that, I want to give a shout out to our Discord, link in the description below. Hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you can find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this episode is available wherever you get your podcasts in an audio-only format. So if you can't find it there, let us know and we will get it there. But let's hop to this week's content. And in this week, I want to talk a little bit about assignment and what happens after assignment and how you can wheel on out of that. Now, you've heard us talk about the wheel strategy, and let me just first back up a little bit on how we got here. There was a couple of trades that I took, one in Dollar General and the other one in AI, where I was selling put premium against it. And one of the risks when you sell naked puts is you could be assigned those shares. In both of these instances, I felt pretty confident that longer term, those shares were going to bounce back, even if they were hit on the short term as far as a dip. AI was just a high volatility play that I put in. This is C3 AI as the company. Dollar General was actually an earnings trade that the earnings went very poorly and it crashed through the bottom of my put. And so I ended up picking up assignment. And both of those companies happen to have earnings next week. And as you might have recalled in previous episodes, one of the areas of highest volatility is the week of earnings, because those earnings are a binary event. And with that binary event, there's a lot of uncertainty. And so volatility really jacks up on the option chain for those strikes. And it's kind of like an earnings play, but I already own the shares. And so what I'm looking to do is milk a little more premium off of these things heading into earnings with the high volatility. If I get assigned, that's fine. I'll get those shares called away from me. And that's part of the plan anyway. Whenever I take assignment, my goal is to sell premium against it, to lower my cost basis, and then eventually get those things called away from me. Now, an interesting thing will happen where even though my strikes might get breached on the call side, I very likely will have the opportunity to roll these things and collect even more premium. And so we'll talk about that in a minute. When it comes to AI, they happen to also have earnings next week. Now, I didn't get into this on an earnings play. There was just a lot of high volatility back when I was playing it. I was playing a strangle. So I was selling both premium on the high side and the low side, and they went through a little bit of a rough patch there. I got assigned on the low side, but I had collected quite a bit of premium, and we'll talk about where my cost basis is and where the volatility sits going into earnings next week, which is why I want to try to milk some premium and potentially get assigned to exit these shares and get some of that capital returned back to me so I can deploy it somewhere else. All right, so first up, we're going to take a look at Dollar General. Now, Dollar General was a stock that I traded earnings on last earnings. So I've had this thing now for almost a quarter. And I'm going to pull up the chart here real quick. And you can see this earnings announcement right here with this massive just drop down is where I took assignment. And I actually sold the 140 put here. And so you see we fell off from about 157, 150, 55, somewhere in there. I thought 140 was a pretty safe level where we were going to pause and maybe get a little bit of a bounce back. We did get a reaction at the 140 level, but it gave up that 140 level. And so, I tried to carry that thing. I actually took assignment around the 140 cost basis. I originally sold a strangle. Basically, I went on the put side and the call side around earnings. And I'll put a link to the episode where I called out this trade because we went through some of the mechanics of that trade. I collected $2.68 on that strangle. And after earnings, we just crashed through the bottom. I think the put side was 142. The high side was 170. We broke through that. And after earnings, I let the call option expire worthless because there was no chance we were breaching 170 after that earnings strike. And I took the put side and I rolled the put side out. And I actually ended up rolling it up a little bit because I wanted to pick up more of that intrinsic value from where my other strike was. And so I was able to roll that for $3. But I sold the 145 strike. So I effectively was $5.68 in premium, and I was assigned at 145. So you take that off, and my cost basis is around 130 and 40 some change there, 139 and 40 some change, 42. So 139.42 is my cost basis in there. So if I was to get assigned at 139.42, I would effectively be out of the trade for a scratch, which isn't too bad, but I'd really like to try to pick up some premium, maybe in addition to that. And, we might not break through the strike that I sell at. So then I can kind of go again and lower that cost basis. This is one of my rougher trades where I got pretty deep into the money. I mean, this thing went, remember, I was assigned at 145 with a cost basis of 139 and change. And this thing went all the way down to 101. So very deep in the money at a pretty big and red loss. And so if you look at the chart, we've kind of been slowly climbing back out of that. I was able to collect dividends along the way because that's one of the benefits of being assigned is you're now a shareholder. And so any dividends that stock does offer, you will collect. So I believe it was a 60-cent dividend or 59-cent dividend, something like that was in there. And I collected. And the other key point that I want you to draw your attention to is look at this line chart here that turns green. This is the volatility. This is volatility leading into the previous earnings announcement. This drop off in volatility is that after earnings pop from volatility. And so the same thing is going to happen again. You can see we've been climbing and climbing and climbing in volatility into earnings. We are now actually at higher volatility levels than the last earnings. Now, this time I own shares. And so I don't want to sell a put because I don't want to own more shares. I want to have my shares called away from me. And so I want to look at the call side of this trade. So let's hop over and take a look at the option chain when it comes to, what does the option chain show us with things in here. And so what I want to call out here is we got our different dates up on the screen, and this is the volatility level of that week's options expiration. So you can see one's expiring this week or 28% volatility, 35% volatility for next week's weeklies, and then the week after that, which is when the earnings announcement is, I believe December 7th. So these expire on December 8th. Boom, we almost double in volatility to 64%. That's because this is the week that the earnings announcement is. And so this is the most volatile option chain. And then you can see everything after that has decent volatility because, again, that all stems from that unknown binary event of earnings. They don't really know what's going to happen there. And so there's there's volatility that will bleed over into subsequent strikes. And so that's why you see it kind of climb up, bam, peg 65% because that's the most volatile. And then it starts to kind of come down a little bit, but there's a lot of that uncertainty from that week that's going to be baked into all those subsequent chains. Now, once earnings are out, the option chain expiring that week will pretty much vaporize in volatility. And then all the subsequent changes will quickly adjust to that new volatility level. And it will be lower than where it is now because that binary event will be over. So let's take a look here at this chain that expires on December 8th at 65% volatility. And remember, 139 and change is my strike. So if I come down here to, let's just call it 140, I can sell a call at 140 somewhere between 150 and $1.85. Now the markets are closed, so the spread is a little bit wider here, but let's call it $1.60. So I can collect $160 if I sell a strike at 140. And we don't breach through and I don't get assigned. So that means even if I get assigned, I will walk away plus $160. Now, this is only a 20 delta strike. When I am trying to get out of an option trade, if I really want assigned, I'm not going to sell a 19 delta option. I'm probably going to go much more to a 35, 40, maybe even 45% or at the money option. So you can see if I back down here to a 124 strike, I could collect almost $700. Now, am I going to do that? No, not yet, because that will put me at a loss. Remember, 139 and change is what my break even is. So if I got assigned and called away at 124 and I added $7 to that, I'm still below that break even price. So I would walk away red for the trade. So what my move is here is I'm going to wait until we get closer to earnings. Because the closer we get to earnings, I'm going to hope that we get more price appreciation on the underlying stock. And the way that the chart is looking and trending, that seems very likely. And if we can push up higher to that 139 strike, maybe that 19 delta now comes into a 35 or 40 delta. And if we're coming into a 40 delta, I probably could expect to collect around $350 from that. Keep in mind there's going to be less time, so some of that time premium is going to come out, and that's why this 40 delta, which reflects about a $450 collection, will come down. So Dollar General is not quite at a level that I'm ready to sell yet, but I am watching it like a hawk, because if we come up here to that extra earnings at 140 and I do it at my break even, then everything I collect is pure profit. And if we happen to go back down, okay, I still get to keep that premium. If we end up breaching through that, I will go ahead and try to roll out before I get assigned, just to keep milking that premium and force somebody to give me an early assignment. One thing I've noticed when selling calls is people do not typically take early assignment. Yes, it happens, but it is relatively rare to me. For as many of those cases I've been in, I'd say maybe 1 out of 20, 1 out of 25 are actually early assigned. And usually when it's early assigned, it's deep, deep, deep in the money. And so right around where we're trading, I'm not that worried about it. So anyway, that's kind of my strategy when it comes to Dollar General. Now, I could go out in time to a monthly, which would be December 15th. Now, this isn't quite as volatile, but it has still some of that uncertainty. So we can see where a 140 strike would get me here. And you can see I'm not netting that much. I've added an additional week of premium, but really didn't add that much dollar amount to that premium. And that's because the volatility is down to 57% there in that week. And if we come out even to the next monthly in January, which is 59 days away, this should have pretty decent time premium, but the volatility is considerably less. So again, look at this, just a little over $280 in there. So the play here for me is let's watch this December 8th expiration. We want to see the underlying push up closer to that 139 and change, where I can then maybe get into a 40 delta strike to sell against that, heading into earnings with that really extended volatility. So next one up is AI. Now, this is C3 AI company, and this is one that just went bonkers on volatility and price action. So we were getting huge percentage jumps on a daily basis, and I didn't really know what was happening. So I actually put out a couple of different strangles, ended up rolling one of the puts a few times to collect some more premium. I don't believe I actually recorded an episode on this, so I can't link you to that. Just know that I collected a decent amount in premium with a cost basis of, I think I'm about $25 cost basis, maybe $24 cost basis is what my tracking sheet is showing me. So let's take a look a little bit at the chart briefly. Now, this one is not quite as convincing as a volatility play as Dollar General. So right here, you can see back with these crazy spikes where we were going from 30 to $43 and back down and then spiked up. This is where I was selling strangles and rolling puts where there was just so much volatility. The stock's volatility really quieted down. You can see down here, these blue bars are volume, and you can see we really, really, really fell off on volume and kind of been nestling into a little bit of a groove. So I was collecting premium back there. Like I said, around $24 is my break even on where I was assigned. This thing traded down here into the low 20s. We started to kind of consolidate down here, and we've started, the price action is kind of now moving up. We do have earnings coming out in about a week. And so this chart down here is red. So we're not really in that overextended volatility that I really like to see. However, we are above my strike price. So remember, my cost basis is from 24, and we're currently trading at 28.50. And if we switch over to the options chain on this one and take a look at where the volatility is in the chain, we'll hop over here and you can see we spike up here on that December 8th week. Again, I believe December 7th is the earnings for AI. That's 114% volatility. Is that extremely extended from where we are now? Well, we're at 96%. I think some of this is to do with the open AI turmoil that's going on of recent history, and then 81% kind of settles in, and we spike up to 114. So this isn't overextended. So this isn't really where I would look to sell premium. But because I'm looking for assignment and we're already above the cost basis, let's shop around. So if I open up that December 8th expiration, now this is the week of earnings, December 8th. So it's one day after earnings. Right here, you can see I would typically want to go for probably this 45 delta, maybe making a nice even 30 strike. So if I got assigned at 30, my cost basis is 24. So that right out of the gate at assigned at 30 is $600. Now, selling at a 30 premium would net me likely another $200. And so I have these shares. AI does not pay a dividend, but selling this premium going into earnings with that 114% volatility, I could walk away if this thing pops and hits my strike with $800, $600 of the implied difference from where my break even was at 24 to the strike price of 30. Plus on top of that, I'm going to collect that premium of $200 there. This is, again, I'm going to maybe wait a little bit more into next week as we kind of get closer to the earnings. I want to let that volatility try to creep up a little bit more. Hopefully we continue this price action trend of price appreciation and we get closer because, the more we get ahead, then, the higher I can set that strike price, and I'm going to pick up that intrinsic value difference from that 24 cost basis that I'm in on the AI. So that brings us to the end of this week's episode. And what I want to call out here is, yes, I'm holding these shares. They're not taking a considerably high number of my buying power. I'm looking for the opportunity to go ahead and sell more premium against it, collecting more money. I try to do that always above my cost basis, because that means every more premium that I collect is straight profit that I get to keep. And ideally, we'll keep moving with price appreciation prior to selling those strikes. Collecting that premium. If I go ahead and breach the strikes after there and go into the money, I will try to roll, again, trying to force that other party to take early assignment. Just letting the option expire in the money, if there's really not much intrinsic value to a roll, or I really want out of the shares, sure, I guess I can let it expire. But if I can push it out a week, push it out 2 weeks, I will always collect more premium for that, because I'm adding time. I'm buying back the cheaper option. I'm selling, again, more expensive out in time. So why not do that? And if the person holding the option really wants to exercise it, they are allowed to. But it kind of forces them to take that early exercise, which not a lot of people do. I found this in the Apple holdings that I had, where Apple was deep in the money on my calls and nobody ever called it away from me. They just kept holding the calls. Now, that could be because people are very speculative in the way that they buy the calls and they really want to just wait to the end for some magic to happen. I don't know, but I do know that the early assignment on there has been relatively few and far between. So why not take the roll a few days earlier, collect more premium, and if somebody calls you out on it, takes the early assignment, so what? You've picked up that extra premium from taking the roll. And so this just goes to show it's the back half of the wheel. The first half of the wheel is selling that put, and then ended up rolling and rolling and rolling until you get assigned. Eventually, if you get assigned, then you wait, you calculate, you got to keep track of all your cost basis, and then you go ahead and sell calls against your shares that you've been assigned, but make sure you always do it above the cost basis, and you just kind of create this flywheel of premium collection. So those are some of the trades that I'm considering. Stay tuned to that thetagang.com/sprocket888. You can see what my actually entries are when I take them, if I take them, and we will keep you updated on future trades that I embark on. I hope you guys have a great holiday weekend, or had a great holiday weekend, because this will air after the holidays. And remember, think outside the block.